We're going to kick off with a panel discussion in just a moment, and you will have plenty of opportunity to pose your own questions to the panel. But before that, I wanted to give each of the other panelists a few minutes to set their own scene, if you like. Let me just introduce them very quickly. Next to me is Deirdre Milan, the CFO of Diageo. You've got their bios in the program, so I won't go into any detail. Ken Gregor is the CFO of Jaguar Land Rover, sitting next to Deirdre. And Evelyn Bork is the CFO of Bupa since September 2012. I think I'm right in saying. So is this the CFO space? Gregor clearly thinks it is. Do CFOs need to be part of the conversation? As a layperson coming to these events, my research for this one was typing CFO and sustainability into Google, and it was surprising what you get, just how strong some of the views are. Accenture says sustainability must drive a firm's strategy instead of just taking a few token bullet points in a company's strategic plan. CFOs must take the lead as they are best equipped to explain to the market how sustainability issues will affect performance. And that's something we're going to touch on as well this evening, the shareholder issue and Apple and Tim Cook and that quite infamous exchange will no doubt be mentioned. Let me start, Deirdre, with you. I want to hear this from the horse's mouth, and the question is a simple one. You clearly think CFOs need to be part of this conversation. I guess you wouldn't be here otherwise. Why? Why do they need to be part of it?
I mean, ultimately, and Gregor referred to it in several respects, I mean, the CFO as a significant business leader in the business, and often, in particular, in PLCs, sitting on the board, are key in setting the strategy of the organization, but also play a key fiduciary role in ensuring that the organization continues as a going concern. So the whole concept of sustainability and the tension versus short and long-term returns sits often, or if not starts with, ultimately ends with or passes through the CFO. Yeah. So when you're having a conversation with an investor or with your board about whether an investment can be made or should be made, and whether it be in people or in brands or in sustainable energy, the CFO needs to be integral to the decision.
You talk about fiduciary duty to the shareholder. Let me bring in that NCPPR question to Tim Cook at the Apple shareholder meeting. Do Apple's environmental investments increase or decrease the bottom line, was the question. It upset Tim Cook. Was it a fair question?
I think it's a fair question. The question is, over what period of time are you talking about? And I had an investor once challenge me on why I was making an acquisition that didn't improve my return on invested capital in the current year. And I said to him, well, quite simply, I am responsible for ensuring we get returns in the short, medium, and long term. And I think that's what sustainability is about. If I made all of my acquisitions, all of my brand investments, all of my people decisions about what was going to happen right now, you would not have a going concern over a long period of time. And I think history is littered with companies that have made short-term decisions, not necessarily about environmental or natural capital, but in general, very short-term decisions that have damaged either the reputation or the returns of that business over time.
You're all companies that have done a lot in this area, and do feel free, by the way, during the panel discussion to bring up what your companies have done. But let me finish with this question. With, of course, some of the big investments in on-site renewable energy generation that you've made in mind, is it getting easier to persuade the board to invest in long-term projects now, would you say?
Relating specifically to sustainability?
Yeah, relating to sustainability.
I think it is, because the level of awareness about the implication of not making good use of scarce resource is now becoming something that we're talking about. I think 20 or 30 years ago, when it felt that the resource constraints were not as substantial as they are today, it was harder to make that argument. But today, I mean, we are involved in a business that makes significant use of water.
Yeah.
I mean, one of the biggest programs that we have in water-challenged countries like Africa is to make sure that people have access to water and that we're using water responsibly. So when it comes to energy, for example, I mean, I think some of the examples that are noted for Diageo are some investments we've made in renewable energy in Scotland that had a 17-year payback. And I think when you're making those investments, you're making them because you're actually committed to Scotland, to what's happening there, and also to be able to have a sustainable business over the long term. Because it's not just about the immediate return, but you have to evaluate risks and unknowns on, what is going to be access to energy in the future, what is the cost of that energy going to be, and therefore, how can you be thinking about accessing it today and in the future for the best outcome?
Very good. We'll come back to this, no doubt. Ken Gregor, similar questions to you. Let me start with why you're here tonight. Can you allay the concerns of people in this room who feel that that finance professionals are not totally on board?
I hope so. I mean, I had a very similar perspective to Gregor and to Deirdre in terms of the role of the finance professional at the heart of driving sustainable success for business, not just in the short term, but also in the medium and the long term. And so it's interesting, the concept of a dilemma. I mean, yes, there's a dilemma about what investments to make and etc. But the concept of a dilemma around creating a business that's sustainably successful in the longer term just didn't seem to me actually to be a dilemma. They were almost, it was very much two parts of the same coin.
Are you speaking professionally or personally?
I suppose I'm speaking a little bit of both, because with our business in the car business, our products clearly emit CO2, and so a big challenge for us is to create products that reduce those CO2 emissions over time. And we're investing today to produce the products of 5, 6, 7 years into the future, and that means more fuel-efficient engines, that means lightweight technology, that means hybrid and electric vehicle technology that we're investing in today. And quite frankly, if we don't make those investments today, we won't have a business in 5, 6, 7 years' time. So the two sort of aspects of, is there a dilemma or not? Yes, there is, but actually fundamentally I actually felt, you know what, yes, but it's not as big as one might think it should be. Largely because our entire future is about creating a sustainably successful business, and we can't do that if we don't invest today in those technologies that give us the opportunity for that success in the future.
Jaguar Land Rover have had some pretty good years recently since the takeover. When times are tough, in business, does it, with this hat on, this sustainability hat on now as well, is your resolve strengthened, or does it make things a lot harder for you?
It's a good question. I would think about, if I thought back to 2009, which for us was the depth of the downturn for our business, one of the things we did in 2009 was to invest in a small Range Rover, in the Range Rover Evoque, or at least commence that vehicle program. And that was with an eye to needing to have products in the future that would give customers a choice about what they wanted to drive, and give customers a choice to drive vehicles that had, and yet drive a Range Rover, but with smaller displacement engines and lower, higher fuel economy, lower CO2 emissions. And so, yes, those choices get more difficult in a really tough economic environment where you may be battling for your survival, but I guess I feel you're always battling for your survival. You're battling for your survival both in the short term, but yes, we may have had good years today, but we're still battling for our survival, but we're battling for our survival in the long term. So it may not feel as tough today, But in some respects, that's you've got to guard against that complacency that makes you feel that you're not. You are battling for that survival 5, 6, 7 years into the future all the time.
We will certainly pick up on that as well. Evelyn, not having shareholders, do you feel that gives you a commercial advantage over organisations who have to deal with institutional shareholders, hedge funds, the sort of shareholders who Tim Cook came up against?
Well, I think my board would disagree with that, because even though Bupa is this really strange beast that is company limited by guarantee with no shareholders, because our primary source of any capital for investment is retained earnings, we have to be run on commercial lines. We have to make an acceptable return on capital. I think the freedom that our organisation structure gives us is we can think more long term, and maybe we can stick with decisions which we believe will eventually come good through those times where in a shareholder organisation they might get turfed because you're hunting for the last penny for the dividend or whatever happens to be the pressure at that point in time. But our board feel their job as guardians of the purpose of Bupa and guardians of Bupa's continuity into the future is to make sure that as a business we are continuing to grow and deliver on our purpose across the world and do that profitably.
Do you, just before we started this evening, perhaps this is a little bit unfair of me, but you told me sustainability didn't really come into this for you until what, about a year or year and a half ago? Well,
it's funny that you ask about the CFO's dilemma, because I actually had a dilemma, but I wasn't aware of it, and that was actually that in Bupa we had put out, we published a target back in about 2009, where we said by the end of 5 years, taking us to the end of 2015, we would have reduced in absolute terms our carbon emissions. Yeah. Now, one of the things that actually tends to get finance people very motivated very quickly is an external target. And actually for us in Bupa, it was the only external target. So the corporate affairs director actually went on the hunt for me and said, Evelyn, do you realise if we don't get on this now at the beginning of 2013, we're just absolutely not going to get it. And what does it mean for the credibility of any target that Bupa would ever want to put out if we let it slip? So he absolutely got my attention. But the other piece was that it's easy to assume that someone else is worrying about it. I think what I realised was that without finance getting on board, first of all, we might be inadvertently blocking it, because we do feel ourselves as custodians of the capital of the group, and we do challenge all projects and make sure they're delivering return. Yeah. But actually, not unintentionally, we could actually have operated against the sustainability agenda. The other thing which was quite remarkable was, once the project started coming to the fore, when we created an energy saver fund to provide some additional seed funding from the centre, the number of commercially very sound projects that emerged was fantastic.
Let's open it up now and throw around a few of these issues. And by the way, if there is something that someone says that you want to take issue with, do put your hand up. I'll let you jump in the middle. Gregor, the cynicism that we have witnessed over the past decade, is that for you, when you look at the CFOs, your peers in this space, is that getting noticeably less for you? Are there fewer and fewer cynics now than, say, 5 years ago?
Well, I think there's far fewer cynics. I think, certainly we as a company, after the banks, our industry is probably public enemy number one, certainly a year ago. And I think the realisation is that it's not just about the environment, it's about social, it's about the community, it's about being responsible. And as corporates, we have a long-term vision. We're sometimes pushing back. The data was saying, shareholders saying, looking at a 6-month basis or even a quarterly basis. We run a long-term business with 25 to 60-year life assets. In fact, some of our dams are depreciated over 100 years. And we need to look at the long term. And we need to look at what is right for the business. And I think that issue of being responsible probably has accelerated over the last 2 or 3 years, certainly since 2008.
But why is the CFO taking on this responsibility? Well, why don't you leave that to the sustainability folk?
Well, I think the CFO, is part of the main board. Your director of sustainability will probably not even be on the executive committee. Your chief executive has many other things they have to deal with. As a custodian of the capital appraisal model of projects and acquisitions, you're right at the forefront. You have more time to drive these things forward. And my CFO, my CEO will come to me and say, well, what about the returns here? You have an ability to make a judgment. I would like to go further. I want to put value on certain kind of intangibles and subjective areas and take that forward. And that's why CFOs really are at the forefront.
So, all right. So, let me throw this out there. So, companies who don't have someone on the board who is running with the sustainability or corporate social responsibility issue have got an issue in this area, have got a problem in this area, if they're leaving it up to the sustainability people. Is that right?
Not necessarily. But I think your strategy is at the core of the board, and therefore the CFOs are in the best position to take that forward.
Evelyn, are you talking about this at every board meeting now? And Deirdre, same question to you. Do these issues arise at every meeting you have?
No, I wouldn't say they arise at every meeting, but but they do arise, when we have soul-searching discussions about is Bupa serving the purpose for which it was set up? Because, Bupa is a purpose-driven organisation, and we see our purpose, longer, healthier, happier lives, as including the impact that we have on the world that we operate in. So our board expect us to be mindful of this, and they expect us to see, for example, it reported as part of a set of balanced scorecard measures, expect us to demonstrate that we're making headway on targets that we set ourselves.
Yes, Ken.
We're discussing it every month, and I suppose for us it's part of our future product planning. So every month we have a product committee where we look at our future plans for new vehicles, new engines, new facilities, and in every one of those product decisions, the CO2 is one of the key metrics in terms of the top 5 key metrics that we've got to plan for and make sure is in the right place. And each of those product committees starts with a discussion around the overall fleet sort of view of our future vehicle fleet and how that CO2 compliance picture looks, and whether we've got enough actions in place to address what we think the customer is going to be asking for, as well as what the regulators are likely to be regulating for. So it's very much part of that product planning process. And I'm primarily thinking about CO2, of course, in this discussion, but that's the piece that for us really drives the sustainability agenda, its primary focus, if you like.
Deirdre, I asked Ken this before. When times are tough, how does the conversation change, or maybe even revert back to what it was previously? Diageo's had a tough time in the US. You've had a tough time in emerging markets. Is the conversation now different to the conversation a year or so ago?
Yeah, I don't think so, and maybe it is because the whole conversation about sustainability over the long term is now much more front and center. I think when times get tough, there is a more difficult conversation in general about resource allocation. But I think now more than before, the kinds of investments that are important for what we would say are our commitment to long-term sustainability are those that would be the easiest to approve. Because again, this is something that says, when we're talking about efficiencies, should we drive an efficiency this year or should we drive an efficiency next year? Different point. But, and the point has been made several times, if you don't make the investments today, it's something that is going to be invested in over 10 years from now is going to have the impact. So while we're not as capital intensive as the auto industry or as energy, but we are accustomed to operating a long term. I mean, if you're in the business of Scotch whiskey, you're already well understand what it means to invest today and not get a return for some time. And I think that is now, it's just become part and parcel to the decision making about what are the things that we need to do today to make sure that our industry and our business is sustainable over the long term. So.
I want to talk, I read a fascinating interview with the CFO of Coca-Cola, Nick Janjani, who said we need to better communicate the value gained from investment in sustainability. Coming back to the shareholder and the skeptical institutional investor, how bad a job are your companies doing at communicating this value?
Well, I can answer from SSE. I remember my early days as finance director going to meetings with shareholders where corporate social responsibility, you went and did a separate meeting with them. You weren't in the same meeting as the kind of core shareholder, fund manager. 2008 changed the institutions. They got rid of a lot of the corporate responsibility people, and we're now seeing them coming back, and we're seeing them coming back more kind of in a kind of combined basis in meetings. The key thing for shareholders is, what are the key KPIs that they need in your business? Are you making the right returns? Are you paying the right dividends? And have you a long-term strategy? And what you have to convince them is that sustainability is very much part of that long-term strategy. I haven't had a shareholder push back on that issue.
You haven't?
No. And we have, we're one of 5 companies since 1998 that have paid above inflation dividends in the FTSE 100. So we're a long-term business. What we have to say to our shareholders, the things that we're investing in the community, these are the things that matter for the long term. If I'm doing a large infrastructure project, if I don't consider the community, that means my next project is going to be problematic. How am I kind of sourcing in the supply chain? Am I making that in the right areas? These are all very important issues that shareholders really don't get into the detail unless things are going wrong. So you're going to make sure they're going right.
And forgive me, I didn't mean to sound rude when I talk about how badly that's being communicated. I guess when I read, quote, interviews like that, I assume that this message isn't being communicated as well as it should be. Is that fair to say?
I mean, I don't think that. I have the same experience. The fund managers, the long-term buy side, understand, and frankly, what's most important to them is strategy. So you do need to be able to explain how your sustainability programs are integrated into strategy, but then they expect that you will deploy it effectively. And they would be more concerned if you don't, because from their point of view, reputation, and Gregor talked about this a number of times, is a very integral part of whether or not your strategy is achievable. So if your reputation as an organization, as a consumer-facing company, deteriorates, it's quite difficult to execute your strategy. So I think they would be today more concerned. I think when you come into this whole question about the tension between the short term and the long term, it's not about fund managers, it tends to be more about sell side activity. And you then have to manage communicating with the sell side as to what's going to be happening if you do have a short term challenging performance.
I guess another part of that, I talk about communicating the message. Another part of that is the creating a new interpretation, or needing a new interpretation of what value means as part of this discussion.
It's a good question. I was still thinking about your last question a bit, because in terms of, I guess I think there's probably still work to be done in terms of communicating by companies on this agenda. So I was sort of personalising it a bit into our business, which is a member of an Indian group, Tata Group, and sometime in the early 20th century, the Tata family donated something like 2/3 of the shares in their company to charitable trusts, which they set up in India to promote education and health and other sort of largely philanthropic sort of aspects. And so in a sense they were inventing corporate social responsibility before the acronym had been invented by a good number of years. But I actually felt, you know, in terms of your communication question, that's probably something that helps us as a business get our message across, is being part of that family of a group that has some very clear values that it's stuck by for a very long period of time, and it's been very consistent with its message in terms of yes, we're a business, yes, we're here to make profit and returns, but we're also about doing that as part of a community, and demonstrably so, because ultimately some piece of that return goes back to the community in the form of through those shareholdings and through those trusts. So sorry for not answering your last question. I was still cogitating on your penultimate one.
I would say that the challenge is that there are many different audiences, because they're your customers, your employees, the communities that you're in, and your shareholders. You know, with the best will in the world, I think shareholders can get a bit overloaded with metrics, and typically you go through phases of giving more and more, and the next thing you get back is, well, we'd like less and less, but much more transparency and clarity on the value drivers. But keeping out there your message that it is one of your key business values, and it's something you're focused on, making sure that that's understood, and then, you know, doing all the good stuff behind the scenes of ensuring that the actual investments you make do start from sustainable principles. I think where the rubber actually hits the road is when something goes wrong. Right. And if you at that point as an organisation have been exposed as actually having taken some sort of shortcut in pursuit of very short-term profits and having mortgaged, you know, the future in some way, be it, you know, some asset or some environmental consequence or doing some other thing which is just not regarded as a good thing to do, I think the reputational damage is almost disproportionate to the financial consequences. And I think that's what the CFOs actually have to keep in mind.
I want to come back to an issue, or something that Gregor was talking about, natural capital frameworks and methodologies. Will natural capital catch on across the board with finance teams, do you think? And answer that, giving us examples of how your company looks at natural capital.
I mean, I think we've got more to do. I mean, I think we're possibly not as advanced as Gregor and his business in terms of how it thinks about natural capital. I mean, I've kind of described a bit already how our business sort of is focused so much on CO2 emissions of the product, and have developed effectively a trading mechanism between vehicle lines internally within the business for CO2 to try to incentivize those vehicles that may have a challenging financial equation, like a battery electric vehicle, for example, versus and incentivize those versus those vehicles which might have a more positive financial equation but less good CO2 equation, and help balance that out. So I'd say we've got more to do, but we've started our approach in terms of thinking about different sorts of measures internally within the business that are not sort of purely financial measures, focused largely linked to the thing that's forefront of our mind in terms of sustainability and those CO2 emissions.
What I suppose I'm reflecting as we're having this discussion on the journey on reporting on risk. You know, you go back 5 years ago, and the assessment of risks of projects, or even the discussion of risk management in businesses, was really quite immature, and the starting point was starting to actually write risk into the script. Whenever you were looking at a major investment decision, people had to a certain extent, develop tools, share with consulting firms and among companies how they were doing things, and degrees of best practice have emerged in that field. I think we're still very much in that stage of early days emerging best practice, and you'll see different things. It'll take some time for stuff to actually stand the test of time and become the established methodology. But I think the starting point is making sure that sustainability is increasingly part of the script around major investment decisions.
Go ahead.
I think natural capital is really quite interesting because you have a huge amount of conflicts. If I look at a lot of our renewable projects and our wind projects and some of the environmental kind of views on things like moss in the north of Scotland, protected moss, and having environmentalists out there where actually we're doing something that's very important in terms of CO2. So you always have conflicts, and it's how you value that conflict, how you value that natural capital. It's very, very difficult. And we come from a country in Scotland where we have a huge amount of natural capital. There's more natural capital than we can actually use. But what we've got to realise is that each community within the projects that we're trying to build have different views on how that natural capital should be used. And at the moment, we have a very large wind farm that's next to one of our hydro stations, 2,000 feet up, subject to judicial review. But we've already built a hydro station. But people want to have the right to kind of climb and walk, etc. They'll still have that right, but they want to have their views. And how we allocate that natural capital is very difficult. And that is going to be a challenge. And I think it's a challenge where, in some cases, government and businesses and the communities need to come together. And that's one of the things that we do with wind farms. We have a community fund, we have a regional fund, and we have a local fund. And those go into reinvesting in the community, which I think is really important.
Is there, Gregor, enough of a debate over natural capital among your peers as there should be?
No, I think there's a fair bit to develop there. I think we've got a long way to go on natural capital and human capital. I think also in supply chain, some of the supply chain analysis that's required, we need a lot more work done there.
And we talk about a long way to go and a lot more work done. What do we need to see happen to get this debate going, to get companies to do something?
I think it comes back to some of the things that we're looking at in capital investments, and the IFRS CFO Leadership Network. We've come up with a publication on that. How we assess some of things that we cover, visual immunity in terms of pylons. How do you value that? How much is that worth? What value metrics do you use? What do you put in your investment appraisal? We're on a journey. We're not there yet, but I would want to get to an investment appraisal where I'm not having to make subjective, qualitative decisions. I'm making a quantitative decision where my board say, well, fine, these are the values we're in, and we compare project by project on a like-for-like basis. So it's in development.
Right. Are you?
I know it's not an answer, but
no,
that's just
okay.
fact. Yeah.
Deirdre, are you talking more about this?
Yeah, I think not. I would say we have work to do in this area. Finance is naturally drawn to something, a standardization that will have a natural benchmark. But I think the more capital-intensive industries are drawn to it first because of the nature of how much of the natural resource that they're consuming or impacting. So we would have some work to do. So while we're doing quite a lot in terms of measuring some specific things around CO2 emissions and water and waste to landfill.
Why are you not doing more right now?
I think because the impact of our business on those resources is relatively low. And in any business, it becomes a question of what you're prioritizing the time you're spending on. And also because it's just a debate that we haven't entered into with great resonance. I think if you are a very capital-intensive industry, it's something that's much more front of mind because of the amount of resources you're using.
Your CEO, Paul Walsh, of course, has said a lot about fair tax. He's been quite vocal. Fair tax versus just abiding by the law, I guess, is something Gregor talked about. How much does that enter into boardroom discussion now?
Yeah, I mean, I think that comes into boardroom discussion very regularly. I think we have also published our global tax policy on our website some time ago, and have been very specific about what we will and will not do with respect to tax planning.
Yep.
And I think in terms of our kind of living up to what we believe in terms of our own behavior as a business, it's something that comes up. So we evaluate our tax planning strategy, or review it with our board annually. So these are the things that we're doing, and these are the things that we plan to do. And then, there's another level of governance beneath that on every specific project or planning activity that we would be doing.
And I imagine you're all talking about this a lot, right?
Yeah, I mean, we reviewed our tax strategy with our board on an annual basis, and although we haven't published a sort of fair tax sort of approach, most of the elements of what you talked about are in the tax policy that we reviewed and agreed with the board, in terms of not, for example, not seeking to use clever tax havens or those sorts of mechanisms, for example. So it seems it fits quite well.
It seems a simple, maybe a naive question, but why are you talking more about it?
That's a good question. I suppose there's been so much.
Is it the pressure?
I suppose there is focus, and external focus on it, yeah, and
that's the reason you're doing it.
Paying your fair share.
Yeah,
You know,
paying your fair share.
if you make profits, you pay your fair share of tax. That's what the public expect. And I think we've seen that coming through our industry, particularly the banks have seen it, and I think some of the foreign investors in the UK are seeing it on a continuous basis.
So it's pressure from the public, pressure from peers that is making your companies make these decisions, rather than feeling you're doing the right thing.
No, I think it's doing the right thing and pressure. We've evolved. I mean, 20 years ago, I had a bank coming in every week selling me a tax avoidance product. Yeah, tax planning. You hardly ever see that now. Occasionally, the Big Four will present something, but sorry, Big Four. But I think it's getting less and less, and if you've got consumers and individuals who are seeing real disposable incomes going down, and they see corporates not paying their fair share of tax, it's difficult to look at your long-term sustainability business model and say, well, you're going to continue to be able to do that.
I want to hear your response to this as well, Evelyn. First, Evelyn, why are you talking more about this? I assume you are talking more about it.
It goes back to reputation and risk management, and making sure that you're not doing something unintentionally which can adversely impact your reputation. And it's back to what Gregor said. Generally, consumers are expecting us as corporates to pay our fair share. And in fact, in some ways, I think the spotlight that's been put on it over the last few years has woken up public opinion to the fact that there have been lots of opportunities and methods in the past of minimising tax bill. And the average Joe Soap who gets it taken out of their pay packet every month just probably finds this inconceivable.
Is any of this, this is a very direct question, and I'd be interested to hear what you say, but is any of this stuff that we're talking about an albatross around your neck as a CFO?
I wouldn't say so. I'd say it's just good business. It's good because the other thing which comes back to sustainability for me is, Bupa was set up in 1947, kind of partly a response to the creation of the NHS. Bupa should go on and continue long beyond my generation as a manager, and I need to make sure, as for the period that I'm part of the executive team of Bupa, that we do things which enhance its reputation rather than detract from it. So it's taking that long-term view.
I think if I go back 12, 14 years ago, we were one of the first companies in the UK to enter into a partnership arrangement with Inland Revenue at the time, where you put things on the table and you said, these are things we're doing up front, and you get allocated either low, medium or high risk in terms of their tax sheet. I think tax law is so complex anyway. Trying to make sure your team are doing the right tax compliance, particularly when you've got huge projects. There's a huge amount of tax at risk in any event, and I think a lot of companies that have entered into complex tax planning, tax avoidance schemes, have actually come back to regret it in terms of the amount of time and risk and actually cost to the business ultimately. And I think you'll see more of that happening over the next few years. And it's not just the UK. You know, you just have to look at what's happening with the things like banks in Switzerland, private banks in Switzerland, disclosure and openness. We're going to see more of that come through over the next 2 or 3 years. I'm certain about that. So I think I don't have any problem on it.
Okay. Yeah, I mean, it's a funny question when you ask, is it like an albatross around your neck?
Well, any of this.
I know you meant any of this, and I was thinking back to something. Some of those decisions are actually some of the easier decisions to make, which is an interesting thought. You know, when we have a discussion around adding a battery electric vehicle into our product plan for the future, it's actually a very easy discussion to have because it's crystal clear we need it in terms of consumer demand and meeting those CO2 regulations as well as the customer demand. So it becomes, in a way, it becomes quite liberating to be taking decisions that are around that, solely around that long-term health of the business. And yes, they have a short-term cost and a short-term investment that comes with it, but it doesn't feel like an albatross any more than any of all the other investment decisions one has to take and balance in terms of one's role as CFO. It fits parcel with it. And there are aspects which, funnily enough, sitting here reflecting on it a bit, listening to some of the other contributors, are actually quite liberating in a way because they help you focus on the long term, perhaps a bit more than you might otherwise do.
Evelyn. Sorry, Deirdre.
No, I was reflecting on whether or not any of these items individually is an albatross. I mean, what I find, if I'm going to count anything as an albatross, is the kind of anti-business sentiment that seems to be rising. Because what it does is it tends to magnify each of these issues in a very negative way, regardless of the whole story. So whether it be on tax or whether it be your CO2 emissions or some comment that the CEO makes in an interview, it gets magnified in a way that just reinforces a negative sentiment. And sometimes I find that quite difficult to manage against because we are looking to invest in the right decisions that will be good for us today and in the long term. And that piece is the communication that's often difficult to get out through all of the noise of the soundbite in the headline.
Right, and what that albatross you're describing is that perception of the big corporate, and it's about, and it comes back to communicating in a manner in which you can help change that perception.
Yeah,
I guess,
because
right?
it becomes part of the conversation, which is really not really a relevant data point, but it becomes one because people say, okay, well, everyone out there is going to perceive any particular action in a way. If yesterday's headline was about how people aren't investing enough in sustainability, then it changes the conversation you're having the next day, when in fact the conversation really ought to be the same. I understand your point earlier about reputation. So yes, we have to respond, but it's the same as investors. We shouldn't, I often tell my board, we shouldn't do anything because the investors think we should do it. We should run the business because we think it's the right thing to do for the long term. And I was talking earlier about politicians. So politicians used to stand up and say, this is the way the country should go because it's the right thing to do. Now they go and take a poll. And depending on what the public believes, that's what they say we should do. Well, the public may be uninformed. So I think that the dilemma for us is to be able to wade through what is quite a lot of noise and stay focused on the balance between what are the right decisions to make to have a sustainable business.
I guess this is what I grapple with, and it's something I spoke to Keith Weed about at a crowd event a month or so ago. When times are really tough and the numbers look bad and the bottom line is struggling and emerging markets are here and the US is here, your biggest market's here, isn't it hard to think that way?
Yeah, so we have this conversation, but we have to actively, I've been in meetings with the executive committee where we've just said, okay, well, the latest thing that happened, that's bad news. And the noise is stay the course.
Right.
Because, in fact, the investment community, the very people that people say are driving short-term decisions, they are most concerned about strategy. And that's been my experience. So you have to stay and communicate with them actively and make sure they understand what your strategy is. Now, you know, your short-term share price may be volatile. I mean, it is going to be what it is, and that is the tension. Is that management to not go do something that's going to drive a change in that, you know, in the immediate short term.
And is this easier for you, Evelyn? Or is it the same issue you're grappling with?
It's
really?
the same issue.
It is, yeah.
I mean, you know, if you're experiencing a tough time in a particular line of business or a particular market, and you know, that management team is behind its target, well then, you know, they'll want to do things which may not be to the benefit of the business longer term, but it's actually ensuring that you're having the right conversation and, you know, standing in a space of, well, what's right for Bupa in the round, in the long term overall.
But just before I throw it open to the floor, I guess the way you make decisions, how you make decisions, has changed enormously and continues to change, right?
Yes.
Is that, am I right?
Yeah. Yes.
And that's probably one of the most noticeable changes in your roles, is that right?
Yes, I would say that, you know, definitely. I mean, I would have said,
Unix
going back 5 years ago, risk has only just come into the agenda. Now it's firmly embedded in it, but another facet of risk is the impact you have on the world in which you operate, in the communities in which you operate, and they go to reputation. And I've participated in more board debates around investment opportunities where the numbers look great, but is it the right thing to do?
I don't think I was looking sceptical. I'm just a little bit of a slow thinker, so yet again I was thinking about your previous question.
That's okay, yeah.
What I was thinking about was, and I was trying to work it out a bit, was whether it was easier. I was thinking about 2009 and the downturn, and for us, you know, we were cutting everything and cutting costs very hard, and we did cut employment levels, and we, you know, just across the board doing what we needed to do to survive. But in amongst all of that, what we were also doing was, you know, our lifeblood is future new product, and having that new product available for the customer in 3-4 years' time was the thing that, you know, we were really focused on sustaining and focusing all of our resources, meager as they were at the time, towards those new product investments so that we had that sustainable future for ourselves at the time. And I suppose I was reflecting on, you know, how easy was that to do in the face of shareholder pressures, etc., and some of the discussions you were having. And it may be that for us, with our shareholder being part of the Tata Group, who have a very sort of long-term approach to their investments, it may be that discussion was a little bit easier around that or not. And I guess I was just reflecting that it probably helped to have a shareholder base who was attuned to that long-term sort of sustainable future for our business, so that, you know, we were clear that it was the right thing to do for our business, but we had a shareholder who's intrinsically sort of that minded that way, and therefore when we thought it was the right thing to do, it was relatively straightforward to convince them it was the right thing to do, even amongst all of the pressures that we faced to cut cost and those things, which would have been easy to do, but then I wouldn't be sat here now talking to you.
Sure.